Right now, today, this exact moment, the stock market is doing something it has only done a handful of times in the last 50 years, and the overwhelming majority of investors are going to miss it entirely. Not because the information is hidden, not because it requires a PhD in finance or a Bloomberg terminal or a seat on the trading floor. They're going to miss it because they are comfortable, and comfortable investors are the ones who end up working into their 70s, wondering where the decades went and why the math never added up the way the brochure said it would. This is not a prediction. This is not a theory. This is a rotation, a seismic shift of institutional money happening in real time, right now, across every sector of the American economy. And if you are sitting in a standard index fund and patting yourself on the back for being a disciplined, long-term investor, I am going to show you in the next 25 minutes exactly why that self-congratulation is costing you a fortune. The window on this opportunity is not infinite. Markets do not wait for people to feel ready. Before we go any further, if you are watching this and you are not yet subscribed to this channel, that is a financial mistake you need to correct right now. The analysis we do here, the sector rotation data, the specific tickers, the institutional money flow signals, that kind of intelligence gets sold to hedge fund clients for thousands of dollars a month. You are getting it at zero cost. The only thing it costs you is 30 seconds and a click. Hit subscribe, turn on the notification bell, because the next video we publish may be even more important than this one, and you cannot afford to miss it. Here's the problem that is sitting inside almost every retail investor's portfolio right now. And it is so obvious once you see it that you will genuinely be angry that nobody showed it to you sooner. The S&P 500 is up approximately 9% this year. The NASDAQ is approaching all-time highs. The Dow is flirting with 50,000. You read those numbers and you feel fine. You feel responsible. You feel like the adult in the room who did the right thing, bought the index, stayed the course, ignored the noise. And that feeling, that specific feeling of unearned satisfaction, is exactly what is destroying your long-term wealth. Here is what is actually happening inside that index you are so proud of owning. Micron Technology is up 523% from its lows. 523%. That is not a typo. At the same time, in the same index, during the same period, Nike is down 54%. You own both of them. If you hold the S&P 500, you own Micron screaming upward, and you own Nike in free fall, and your index fund averages those two outcomes together, takes its management fee, and calls it diversification. That is not diversification. That is a mathematical anchor tied to the ankle of your retirement. Now, let me give you a picture that will make this concrete. Think of the entire stock market as a giant swimming pool. The total amount of water in that pool, the total market capitalization, stays roughly constant. The S&P being at all-time highs tells you the pool is full. It tells you absolutely nothing about where the water is. Right now, one end of that pool is flooding. Energy stocks are up 28% this year. Technology is up 16%. Materials are up 14%. The other end of that pool is draining. Healthcare is down 6%. Financials are down 6%. Consumer discretionary is bleeding. The index fund gives you the average depth of the entire pool. The smart money is swimming in the deep end. The index fund investor is standing in the shallow end, wondering why the water is only ankle deep. And now let me give you a number that should genuinely alarm you, because it is the most important single data point in the market right now, and financial media will not discuss it because it does not support the buy and hold narrative that keeps their advertisers happy. The number is called NAAIM. It stands for National Association of Active Investment Managers, and it is a weekly survey of professional money managers that measures how much of their clients' money is currently invested in stocks. Right now, that number is 97 out of 100. 97%. Every professional money manager, the people who do this for a living, who manage billions of dollars, who have access to research you and I will never see, are almost completely all in. Now think about what that means in practical terms. If 97 people are already sitting in chairs and there are only 3 chairs remaining, the game of musical chairs is essentially over. There is almost no new institutional money left to push prices higher across the board. The only thing that moves markets from this point is where the existing money rotates. And I'm going to show you exactly where it is rotating, and more importantly, where it is rotating out of. Because that second part is the piece that is quietly destroying the portfolios of every passive investor who thinks they are playing it safe. There are 3 forces operating in the market right now that are not accidents, not temporary blips, and not going away anytime soon. These 3 forces together explain every single sector, winner and loser, I am going to walk you through. And if you understand them, you will never again look at a headline about the S&P hitting all-time highs and feel satisfied. You will instead immediately ask the only question that matters: where specifically is the money going? Force number one is inflation, and not the theoretical kind discussed in economics classrooms. The Consumer Price Index is currently running at 3.8% annually. The Federal Reserve's stated target is 2%. That means inflation is running at nearly double what the central bank considers acceptable. But the headline number understates the real pain. Energy costs are up 18% year. Gasoline is up 28%. If you have filled the tank recently, you already know this in your bones, even if you did not know the exact number. Now, here's what inflation at this level does to the investment landscape. It is not complicated. Hard assets win, commodities win, the companies that extract, refine, and sell physical things win. Paper-based assets, growth stocks priced on future earnings, bonds, consumer-facing businesses whose customers are getting squeezed, they lose. Inflation is not random. It has a very specific set of winners and losers. And right now, most retail investors are heavily weighted toward the losers. Force number two is the real wage collapse. Real wages means what you actually take home after you account for inflation. And right now, real wages in America are negative. Workers are earning more nominal dollars and buying less actual stuff with those dollars because prices are rising faster than paychecks. That is not a political statement. That is arithmetic. And the downstream consequence of that arithmetic is devastating for every business whose revenue depends on American consumers having discretionary money to spend. Retail, advertising, consumer brands, consulting media, all of these industries are feeding off a consumer who is getting quietly, mathematically poorer every single month, and that dynamic is not a quarterly blip. It is a structural shift that takes years to reverse once it sets in. Force number three is the NAAIM number we already discussed, but let me connect it to the other two forces because the combination is the key. When inflation is high, when real wages are falling, and when professional money managers are already 97% invested, the market cannot go broadly higher in a meaningful way. What it can do is rotate aggressively. The money that was in consumer discretionary moves to energy. The money that was in advertising moves to gold. The money that was in publishing and professional services moves to copper and uranium and defense. This is not speculation. You can see it in the sector performance data right now in real time with your own eyes. The question is whether you are positioned in front of that wave or whether you are standing in its path. Let me walk you through exactly where the smart money is going, sector by sector, with specific names, because vague advice about rotating into commodities is useless. You need to know what to actually look at. And you need to understand why these specific companies in these specific industries are where institutional capital is currently flowing. Start with gold. Gold is not a relic. Gold is not something your grandfather buried in the backyard because he did not trust banks. Gold is the oldest inflation hedge in human history, and it is working exactly the way it always has. Gold is approaching nearly $4,700 per ounce and is up close to 50% over the last year. Central banks globally are expected to buy approximately 1,000 metric tons of gold this year. China, India, Turkey, Saudi Arabia, they are converting dollar reserves into physical gold at a pace we have not seen in decades. And the reason they are doing it is because they understand something that the average American retail investor does not. The dollar loses purchasing power when inflation runs above target, and every dollar sitting in cash is a guaranteed slow loss. The stock I look at in this space is Newmont Corporation. Ticker symbol NEM. This is the largest gold mining company on the planet, over $100 billion in market capitalization. This is not a speculative junior miner betting that someone might find gold somewhere. This is an industrial scale operation with proven reserves, real cash flows, and direct leverage to the gold price. And gold miners are actually outperforming the metal itself right now, which historically has been one of the clearest signals that the move has further to run. Second, uranium. This is the stealth play of the decade, and most retail investors have never even considered it. Uranium is up 21% compared to a year ago, and the structural demand picture makes everything else in this video look conservative by comparison. China has 60 nuclear reactors currently operating and 38 more under construction. The United States government has formally classified uranium as a national security asset. The largest technology companies in the world, the Microsofts and Amazons and Googles, are signing contracts for small modular nuclear reactors to power the data centers that run artificial intelligence workloads, because there is simply no other energy source on the planet that can provide the consistent, uninterruptible, high-density power that AI infrastructure requires at the scale it needs. Now here is the number that should stop you cold. The United States requires approximately 50 million pounds of uranium per year. It produces domestically about 1 million pounds. That is a 98% import dependency on something its own. Government has declared a national security critical asset. The ETF for uranium miners, ticker URA, is up 25% year to date. Junior miners in the space are up 45%. My focus in this sector is Cameco Corporation, ticker CCJ, $50 billion company, the single largest uranium producer in the Western world. When the nuclear build-out accelerates, and it will accelerate because physics and arithmetic leave no other option for powering AI at scale, Cameco is the company supplying the fuel. Third, copper. Every electric vehicle requires 4 times more copper than a conventional gasoline-powered car. Every solar panel requires it. Every wind turbine requires it. Every data center requires it. Every power grid upgrade requires it. Copper is up approximately 40% over the last year, and Bloomberg Intelligence is projecting the copper market will swing into a deficit of 1 million metric tons, meaning the world will consume 1 million more metric tons of copper than it is capable of producing. Supply problems in Indonesia, Chile, and China's restriction on exports of materials needed for copper processing are simultaneously squeezing the supply side. The company I look at here is Freeport-McMoRan, ticker FCX, $80 billion market cap, the closest thing to a pure-play copper company that exists at institutional scale. When copper moves, FCX moves with leverage. Southern Copper, ticker SCCO, at approximately $160 billion in market cap, is another name worth studying in this space. Fourth, energy broadly. Energy is the single best performing sector in the entire S&P 500 year to date, up approximately 28%. And inflation, driven largely by energy costs, means the companies extracting and selling energy are, almost by definition, the direct beneficiaries of the same force that is hurting every other sector. Total Energies, ticker TTE, is the name I keep returning to here. $160 billion diversified energy giant with exposure to oil, gas, and renewables, diversified enough to manage regulatory risk, large enough to have the balance sheet strength that institutional investors require, and positioned directly in the sector where the money is flowing most aggressively. Now let me add a layer on top of the commodity supercycle, because when commodities run, they pull an entire ecosystem of supporting industries with them. Infrastructure and defense are the shadow plays that almost nobody in financial media discusses, and they have been producing absolutely staggering returns, while retail investors argued about whether NVIDIA was overvalued. General building contractors in non-residential construction are up 330% as an industry, electronic components up 300%, engineering and construction companies up 200%, water and sewer pipeline companies up 200%, semiconductors up 170%. These are not meme stocks. These are companies with government contracts, real physical assets, real engineering backlogs, and revenues tied to the biggest capital expenditure cycle in American history, which is the rebuilding and upgrading of the entire physical and digital infrastructure of the United States economy. In the physical infrastructure layer, Comfort Systems USA, ticker FIX, is an engineering company that does the mechanical and electrical systems for exactly the kind of facilities that data centers require. It is up 500% from its lows. Seagate Technology, ticker STX, at approximately $90 billion in market capitalization, is the data storage backbone for the cloud infrastructure. Explosion, Celestica, ticker CLS, does the electronic manufacturing that powers cloud and AI hardware and is approximately 700%. In defense, Rocket Lab, ticker RKLB, is up over 2,700%, operating at the intersection of space launch and defense technology, where NATO spending commitments and ongoing global conflict are creating a demand environment that defense contractors have not seen in a generation. RTX, formerly Raytheon, the defense blue chip, is up approximately 69% and represents the more conservative entry point in the sector. In infrastructure construction, Mastech, ticker MTZ, specializes in power lines, pipelines, and infrastructure construction, and Quanta Services covers electrical power, oil and gas engineering, and construction, both directly tied to the decades-long American infrastructure rebuild that is funded, contracted, and already underway. Now I'm going to tell you something that is going to be uncomfortable to hear, and I want you to sit with the discomfort rather than reaching for a rationalization. Because the rationalization is what got you here in the first place. You are not just missing the winners, you are actively funding the losers with your own retirement money every month and calling it a strategy. Shoe manufacturing as an industry is down 37%. Nike specifically, the company whose logo you probably have on clothing in your closet right now, is down 54%. The company is being crushed by a combination of declining consumer discretionary spending driven by negative real wages, increased competition from direct-to-consumer brands, and a fundamental failure to adapt its business model fast enough. You own it. If you hold any major S&P 500 index fund, you own Nike stock right now, and it has destroyed more than half its value while you are feeling good about your diversified, responsible investment approach. Professional services and consulting firms are down 30% as an industry. Booz Allen Hamilton is down approximately 50%. This should surprise exactly nobody, because the single most disruptive technology in human history, artificial intelligence, is coming directly for the consulting industry. When a large language model can produce in 4 hours what a team of consultants would charge $400,000 for over 6 weeks, the billing model that built those firms collapses. You own those firms in your index. They are not recovering. The disruption is not a future risk. It is a current reality. Publishing is down 43%. Reuters, one of the world's most recognized information brands, is down nearly 50%. Advertising is down 29%. WPP, the world's largest advertising holding company, has lost approximately 2/3 of its value. 2/3. If you put $30 into WPP through your index fund, you have $10 left, and the structural headwinds from artificial intelligence replacing creative and media buying functions are not going to reverse. Forest products are down 36%. These are not obscure, irrelevant positions. These are the household names, the brand names, the companies you have heard of your entire life. And they are in your portfolio right now, bleeding, dragging your returns downward month after month, while you look at the S&P headline number and feel broadly fine about things. Let me do the mathematics with you now, because percentages are abstract and dollars are real, and the real dollar difference between being positioned correctly and being positioned incorrectly in this market is large, enough to fundamentally alter the trajectory of your financial life, not metaphorically, literally. You invested $10,000 into a broad S&P 500 index fund. The index is up approximately 30% over the relevant period. You now have $13,000. That feels acceptable. That feels like progress. $13,000. 30% gain. Disciplined long-term investor, you are doing the right thing, correct? Now consider that same $10,000 allocated across the winning sectors we just discussed: gold, uranium, copper, energy, infrastructure, defense. The industries performing in that basket are up anywhere from 170% to over 300%. A conservative blended return in the winning sectors puts that $10,000 at $40,000 to $50,000. A more concentrated position in the highest performing names puts it closer to $60,000. The difference between $13,000 and $60,000 is $47,000 on a single $10,000 investment. That is not a rounding error. That is not a statistical anomaly. That is the mathematical consequence of understanding where money is flowing versus not understanding it. Now go the other direction. That same $10,000, if weighted toward the losing industries in your index fund, the consumer brands, the advertising companies, the consulting firms, the publishers, the shoe manufacturers, that $10,000 is now worth somewhere between $3,000 and $5,000. And here is the brutal truth about index funds that nobody in financial media will say plainly. The index gives you the average of the $60,000 outcome and the $3,000 outcome. It gives you the $13,000 outcome and charges you a management fee for the privilege of mediocrity. Wall Street did not build trillion-dollar institutions by buying index funds and holding them forever. That is the playbook they market to retail investors because it is enormously profitable for the institutions. You buy the index fund, they collect the management fee. The index holds both the winners and the losers. The active institutional traders rotate between the winners in front of your money and behind your money, effectively using your passive capital as liquidity for their active strategies. The buy and hold philosophy is not wisdom. It is the advice of someone who benefits financially from your inactivity. Every year you hold an index that contains Nike, Booz Allen, WPP, and Reuters, alongside Micron, Broadcom, Cameco, and Freeport-McMoRan. You're subsidizing a losing position with money that could be compounding in the winning sectors. That is not bad luck. That is not the market being unpredictable. That is a knowable, avoidable, correctable situation, and the only thing standing between you and correcting it is information and the willingness to act on it. The speed of technological disruption is not slowing down. The AI revolution is not a multi-decade slow burn the way the internet was. It is moving in months, not years, and every quarter that passes, the gap between the industries being disrupted and the industries doing the disrupting gets wider. The index fund puts you in both. The rotation is happening with or without your participation. The only question is whether your money is in front of it or underneath it. Here's where we are. You came into this video knowing the S&P was at all-time highs. You are leaving it knowing that 55 of the 150 industries tracked are climbing and 64 are declining. You know that 97% of professional money managers are already fully invested, which means the era of broad market tailwinds pushing everything higher simultaneously is functionally over. You know that inflation at 3.8%, real wages in negative territory, and a commodity supercycle driven by nuclear energy, copper demand, AI infrastructure, and defense spending are redirecting institutional capital in a very specific direction. And you know the names and tickers of the companies positioned directly in that flow. You also know that your index fund is holding Nike, WPP, Booz Allen, and Reuters alongside your Micron and your Broadcom, and that this combination is not diversification. It is a mathematical guarantee of mediocrity. The gap between the best performing industries and the worst performing industries in the American stock market right now is the widest it has been in a generation. That gap does not close gradually. It closes violently. When the losing industries finally capitulate completely and the capital that was trapped in them floods into the winners, creating the kind of move that generational wealth is built on. That moment is coming. It may already be underway. The investors who are positioned correctly when it arrives will not be the luckiest investors in the room. They will be the most informed ones. You now have the information. What you do with it is entirely your decision. But sitting still and hoping the index sorts itself out is not a neutral choice. It is an active decision to remain in both the rocket ships and the sinking ships simultaneously and let someone else collect the fee for keeping you there, make the decision, do the work. The window on this opportunity is not going to stay open indefinitely.